Hello, intermediate accountants. In chapter 4, we're going to be reviewing the accounting cycle, basically the procedure and the system that all accountants use. This is going to be pretty much the same thing that you used in financial accounting because just because the accounting course changes doesn't mean the system changes. Doesn't matter how far you go in your accounting studies, every single class that you have is going to use pretty much the same exact version of the accounting cycle. And what is the accounting cycle? Well, your book has it described as a nine-step process. First step, when a transaction happens or when an event happens to your company, you need to analyze exactly what happened. What accounts are going to be affected by this transaction and how is their balance going to change after the transaction? And once you've determined that, you need to formally record it in your books, and you do so via a journal entry to keep a chronological record of all the events and transactions that happened during the period. From your journal, you transfer whatever you recorded in the journal entry to your company's general ledger, which is just a bunch of different accounts balances and a running total of what that balance of that account is. And at the end of the period, after you recorded all the events and transactions both in the journal and you posted them to the ledger, you need to make sure that one of the golden rules of accounting is true, that your debits equal your credits. So you would prepare an unadjusted trial balance to make sure you have, as they call it, debit credits equality. And after that debit credit equality is assured, you need to be GAAP compliant. And GAAP says that all revenues earned during a period and all expenses incurred during that period need to be reported during the period they were either earned or incurred. You don't wait until cash actually changes hands. Like when you know the thing happened, you need to put it on your book. So you need to prepare a series of adjusting entries that will account for the fact that all of the revenues and expenses that actually happened during the period are on the books in that period. And after you've had those entries, you also need to post those to the ledger. After that's done, before you make your financial statements, you want to one more time make sure you have debit credit equality. So prepare another trial balance, this time the adjusted trial balance, taking into account your adjustments you made at the end of the period. And once that balance is out, you're ready to make your financial statements. And companies make different financial statements, but the big four that every company makes are your income statement, your equity statement, your balance sheet, and your statement of cash flows, which we'll be going through later on in this semester. But once your financial statements are done, you're ready to report to the external party that wants to use your information. And you're also ready to get set up for the next period. A few of your accounts that you use during the period, namely your revenues and expenses and any withdrawal accounts that you have on the books, are tracking accounts. They track how much of something happened during the period. Well, if you're making your financials for the period's end, the period is over, and you need to be ready to start tracking for the next period. So what you do is you close. You reduce the balance of all those accounts down to zero. In the process of doing so, you also update your retained earnings to the account to the same balance that you're reporting on your financial statements. And then after that series of closing entries is recorded in the journal and transferred to the ledger, you do one more time a check for debit credit equality by preparing a post-closing trial balance. And after that, if you have debits that equal credits for all of your permanent accounts that you didn't close, your accounting period is over and you're ready. Your books are officially closed. So let's break it down a little more detail step by step. Firstly, we're using the double entry system. In the rule of properly accounting using a double entry system is that no matter what happens, all transactions and all events have to affect at least two accounts. Not exactly two accounts, but at least two accounts. In the example down here, we're obtaining an asset. It doesn't matter what it is. We'll say that we are buying equipment in this case. How could you buy equipment? One of three things must have happened for you to buy that equipment. Either you paid in cash, which would decrease another asset, your cash account. You took on some debt to acquire that equipment, which would be an increase in your accounts payable or notes payable, your liability. Or you issued stock to some person that was selling that equipment in exchange for the equipment, in which case there would be an increase in your stockholders' equity. Doesn't matter how you finance it. If you're getting an asset, another account has to be affected in the process of acquiring that asset. So to record that, the first step is to put it in the journal. And the journal is just basically the running record of all of the things that have happened to your company during the period. Journalizing entries is the most important part of the accounting process because it is a cycle. And this is in the beginning of the process. And if you make a mistake in one of your journal entries, it carries through the whole rest of the way. So, of all things in accounting, the thing that's probably the most important to know is the way to properly record a journal entry. And to do so, you're going to need to break down your business into all the tiniest little components you can think of and designate an account for each one of those components. So, every asset, liability, and stockholder equity item you have, including your revenues, expenses, and withdrawals, every single one of those needs its own account. And you can find those in your company's chart of accounts. It'll be a list of all the accounts that your company uses on its books. As a word of precaution, every company has one of these. They have a chart of accounts. If you're using software, it's somewhere in the software. You can just find it in a drop-down list somewhere, view chart of accounts, and it'll show it to you. Please be mindful of the names of the accounts that you have on your company's chart of accounts. Companies have more than one bookkeeper. And if you're using a similar but not exact name for an account than somebody else, it'll look like there's two different accounts on there, like it's two different events on the books. For example, we have accrued expenses payable down here. What are accrued expenses? They are all of the expenses that you adjust for at the end of the period. All of your interest expense, all of your accrued salaries expense, all of those things would count as accrued expenses. If your company only uses one account for accrued expenses payable, you want to use that account. Don't make a separate account on your books for salaries payable or interest payable because it'll just be different destinations for the same exact information. So be super mindful of the accounts that you're using and the naming convention when you're recording your journal entries. But from this chart of accounts, you need to identify which two of these accounts at least will be affected by the transaction. So looking through the list, what two of these things or more are we going to use or what are in our journal entry because the balance of them is going to change after this transaction or event occurs. And then once you've identified the accounts, you need to know how to use debits and credits to properly put it on the books. As a reminder, debit and credit doesn't have any implied meaning, increase, decrease, good or bad. The term debit and credit stem from the Latin words for left and right, and that is all they mean. Debit means left in accounting, credit means right, and nothing more. So you're going to have to figure out, okay, I have these accounts being affected. Which ones do I have to debit and which ones do I have to credit? And there's rules for that. Assets increase on the debit side and decrease on the credit side. So if you have an asset in your transaction that you know is going up, well, it's going to need a debit. Liability accounts work the opposite. They decrease on the debit side and increase on the credit side. Common stock accounts, in fact, all equity accounts work the same way as liabilities. They all decrease on the debit side and increase on the credit side. So over here, common stock, retained earnings, and AOP, as they call it, are all equity accounts, which is why they all work the same exact way. And then you've got your subcomponents of equity down here, your dividends, your withdrawals from the company to distribute to owners, your revenues and gains during the period, and your expenses and losses. And the way they work is very much tied to your equity. The company's value overall is its equity. So if equity increases on the credit side, anything that increases the value of your business should work that same way, should also increase on the credit side. Now, these three sub accounts down here, revenues and gains will definitely increase the value of your company, which is why they, just like your equity accounts, increase on the credit side and decrease on the debit side. But dividends, expenses, and losses are all things that will decrease the value of your business. Having to take money out of it to give to owners, having to pay a bill, taking a loss on an investment or whatever, all those things are not good for the value of your company. So they should work the opposite way that equity accounts work. And equity accounts work by increasing on the credit side and decreasing on the debit side. And yep, we can see right here that both dividends and expenses and losses, things that will decrease your equity, work opposite. They increase on the debit side and they decrease on the credit side. So this is the guide over here, if you will, for how each specific account changes in terms of debits and credits. Analyze your transaction, figure out not only what accounts are changing, but what type of accounts they are from this list over here, and then whether they're going up or down. And it'll tell you what to debit or credit in your journal entry. So let's run through, ignore the top of this. We'll just run through some transactions to see why this is the correct journal entry for the event that happened. Issuing common stock down here to receive cash. Well, cash is increasing then because we're getting paid for ownership in our company. And since we are getting paid, our cash is going up. Cash is an asset. Assets increase on the debit side. That's why this journal entry needs a debit to cash. What else is going to change in this entity? The overall value of your company or your equity because you just issued more common stock to raise money. And that's why common stock is the credit because there's an increase to your company's equity. Equity accounts increase on the credit side, so you need a credit to common stock. If you turn around and spent some of that cash to buy equipment, well, then you need to increase the amount of equipment that you have on your books. Equipment's still an asset, it increases on the debit side, so you debit equipment, but you'd also need to decrease your cash because you're paying for it. And if assets go up on the debit side, they have to go down on the credit side, so it'd be a credit to cash. And the list goes on and on. If you provide a service to somebody, oops, sorry about that. If you provide a service to somebody, the asset that you're receiving for providing that service is always going to be your debit because it's going up. Like if you're providing a service to someone and they're paying you $35,000 at the time, that's a definite increase to your cash. Cash is an asset, goes up on the debit side, so we'd have to debit cash for 35,000. And revenue would also be increasing, and revenues increase on the credit side, so that would be an credits to service revenue as well for 35,000. And even if you don't get paid at the time, the GAAP revenue recognition principle says that as soon as you've earned it, it has to go on the books. So even if you perform a service for somebody and you bill them, as soon as you bill them, because you met the obligation of the services that you said you were going to provide, those revenues have to go on the books at the same time. It's the same entry as up above, but now the asset that you're receiving isn't cash in hand. It is a receivable from your customer. So you debit accounts receivable and you credit service revenue. If you pay a bill, in this case, you know your cash is going to go down. And cash, like all assets, goes down on the credit side. So the entry is going to need a credit for cash. But what is going to go up? Well, the amount of expense that you incurred during the period, which is going to be used to reduce your uh, income on your income statement. It's also whenever you file your taxes, also nicely going to be there as a tax deductible expense. But you need to increase the amount of that you have on your books. And in this case, for whatever you're paying, in this case, utilities, you would debit utility expense because expense accounts increase on the debit side. So anytime that you pay for an expense, it's always a debit to yada yada expense, whatever you're paying for, and a credit to, if you're actually paying for, cash. But sometimes you get an expense that you've not yet paid for. Well, the GAAP revenue recognition principle says that all revenues are recognized when they're earned. We're going to follow that same theory for expenses. We're going to recognize all expenses not when they're paid for, but when they're incurred. So, assuming that we paid a law firm here to provide some legal services for us, as soon as they fulfill their obligation to us and they billed us, we have to put that expense on the books at the time that we are billed. So, even though cash is not changing hands in this transaction, we know that we owe it. So we put the expense on the books, but we can't credit cash like we did before because we've not actually paid it. We owe somebody something. We owe this law firm funds in the future. That's a liability, or in this case, a payable for legal fees. And liabilities increase on the credit side. So you know that legal fees payable, or whatever payable you have for an expense like this, is going to be the credit in your journal entry. When you withdraw funds from the business to pay out to your shareholders, your owners, you are going to have to decrease your cash because cash is going to go down. You're taking it out of the business and giving it to your shareholders. And we know that cash goes down with a credit, so cash has to be the credit of that entry. What's the debit? It's the tracking account that you use to account for how much dividends you paid out to people during the period. Dividends, all withdrawal accounts or contra equity accounts, if you want a fancy term, they all increase on the debit side. And since this is tracking how much we paid in dividends during the period and we just paid more dividends, that has to increase. So the entry to pay dividends is always the same. It is a debit to your dividends account and a credit to cash. What if you have a payment in this case ahead of time for something in the future? I say this to all of my classes, and maybe some of you heard this before, but I used to bookkeep for a contractor all the time that required people to make a down payment up front. How do you put that cash on the books when you've not actually provided any services? Like, you can't put the revenue on the books now because you haven't actually earned it. Well, the cash goes on the books like you would expect. When cash increases, like all assets, it needs to be debited. So you'd start with a debit to cash. But instead of recording actual revenue as your credit, you're going to record a liability. You owe somebody something. Um, in this case, you owe them a service in the future, and all liability accounts go up on the credit side. So you're going to need a credit to whatever liability you're going to call those services that are owed to the other party. in your book, they called it deferred service revenue. You were probably familiar with the term unearned revenue, could also go there. Like I said, the companies change the names of their accounts a little bit, but they all have the same substance. So make sure you're using the exact naming. If you're working for a company that uses this as their unearned revenue account, call it deferred service revenue when you're booking for it. Moving on to July 10th down here. What if the payment happening ahead of time isn't somebody paying you for a contract, it's you paying out to somebody else for something? In this case, a year-long insurance policy in advance. Well, the expense recognition principle says we can't put expenses on the books until they're actually incurred, so I can't record an insurance expense right now. But I do need to decrease my cash because I'm actually paying for it. Well, cash goes down on the credit side, so you credit cash for 72,000. And what would the debit be in this case? Well, it's still an asset to you. It's something you're going to use to help you do business in the future. You need to have insurance on your employees and facilities, etc. So that insurance that you are paying ahead of time is going to be something that helps you be productive in the future. And that is by definition an asset. And we call those assets prepaid expenses, or in this case, prepaid insurance. And it's going up. You've paid for more insurance in advance. So you need to increase your prepaid insurance account, which as an asset, like all assets, will increase on the debit side. Few more journal entries over here. What if you're paying for an expense during the period? Like we couldn't record the insurance expense in the last one, but what if you were paying for an expense during the period that's helping you during that period? Assuming here on September 10th that this equipment that we are renting is being used in September right now, we'll get to record the expense right now. So while we still decrease cash the same way by crediting it for the amount that we are paying, the debit now can go to an actual expense. So we don't have prepaid rent right here. We record it as rental expense. What happens when you collect an outstanding debt from a customer? Well, if that customer owed you money, they would have a receivable on the books. You need to take that receivable off the books. It's an asset account. Asset accounts decrease on the credit side. So to decrease that receivable that you have, you would have to credit accounts receivable to decrease it. Now you're actually getting the cash. And assets increase, on the debit side. So anytime you collect on an outstanding account from a customer, this is always going to be the entry, a debit to cash and a credit to accounts receivable. And then lastly, what if someone owed you money and now they are going to, or sorry, what if you owed somebody else money and now they're going to get paid from you? Well, you had a payable on the books if you owed somebody else money, and payables as liabilities will have normal credit balances. To reduce them, you would debit them. If you're reducing the amount owed to somebody, in this case, the law firm from a few entries ago, if you're paying them, you need to decrease that. So we're going to decrease legal fees payable by the amount that we are paying in this case. And since we're actually paying them, the other thing that needs to decrease one last time is our cash. And cash, like all other assets, always goes down on the credit side.